All right, all right. What's going on, everybody? It's Wednesday, hump day. Doesn't really seem like the beige book did much for us. Was looking to see if we were going to come out of this range or not. And the idea was that possibly 1 o'clock, we get beige book. Maybe we get the juice we've been looking for and GTFO out of this range. But that 6,000 continues to be elusive. It is a defined topping pattern, and while a lot of times we end up going down from a topping pattern, it's not guaranteed. So just kind of keep that in mind. It doesn't owe us a move down, right? So we'll see how it plays out. I'm not overly excited about it. It's jobs week. We'll be getting info all week, right? And the deeper we get into the week, the more the job numbers are going to be relevant. It's not that the information we're going to get now isn't relevant. It's just, like non-farm payrolls is the end of the week. It's the biggest one. It's Friday morning. So as we get closer to that, more and more data will line everything out, keep us pointed in the right direction. We've had some topic requests, which is awesome. I love the requests. I just need to check to make sure everything is functioning the way it's supposed to and that the audio is working on the live stream. So, just a second there to make sure it's all good. Yep, everything is working as it should. Yay. I'm hearing it and it's going out live. So, everybody else is hearing it. If you don't hear me, Lanny, which you can't hear me talking, it's on you. All right. So, we had some topic requests today. I'll start with the easier one since I'm basically the only one that can really talk on this topic, anyways. There was a question about these COG lines, COG lines, and they've been around for a long time. Let me get to a chart that doesn't have anything on it. Yeah, there we go. So on the SPX and on the ES, there is these lines that we call cog lines. They've been around for a long time. I've been using them since we were in the 2800 area. So, like way back here, I was using them. So, the idea is we have these repeating levels, uh, 11, 32, and 92, right? So, you could take a line and you could just lay it out at every one of those numbers. So we'd be looking at 2511, 2532, 2592, and then 26, 27, 28, on and on and on and on and on. There are more levels than that, but I quit validating these levels way back when we were in the 3000 area because it takes so much work to validate these levels. And so while sometimes there's a 42, sometimes there's something in the 60s, it's just so much work. And the ones that were sticking every time was the 11, the 32, and 92. It didn't seem to matter where we were, those three always were there. The other ones, like 42 and 62, those weren't always there. So after a while, I just said, well, forget it. I'll keep those levels in mind, but I'm not going to take the weeks and weeks and weeks that it needs to validate these cog lines anymore, right? Because it's just so much work. The work comes from the options data, especially in the SPX. Not recently, I eventually over time realized they worked on the ES futures as well. SPY has something similar, but they don't line up perfectly, right? And that's again, it just takes a lot of work. So these cog lines, you should think of them as a safe zone or in a safe area, and it's not to the tick perfectly right on the line, right? It's when price gets to that level, we would expect to see the options recognize that level. And think about it, the SPX isn't open overnight, so you're not going to get anything during that time frame. And then during the day, there's so much noise going on that oftentimes it's hard to see it. It's why I mentioned it takes a lot of time to validate these levels. And I didn't think this stuff up, right? It's something that I learned from somewhere else. Don Kaufman is the one that really popularized these lines. And unfortunately, he gave them a name from something that already existed. So if you was to go and Google cog lines, it's very likely you'll find material from John Euler and the work that he did in this completely separate tool that focuses on COG lines. COG is center of gravity. The gravity part of that is the idea that when we get there, it's like a safe zone and price will kind of hang out around that level. And what happens is we end up like gravity sticking to this zone, and then we have to fight to get away from that zone again. And we'll see the options flow really pick up when we finally do leave that zone again. Now, I mentioned that, it takes a lot of time to validate these levels. If we've only been to a spot once and we were there for 2 minutes, then we really didn't have a chance to validate that level. So if we look at all time highs and we go to zoom in here, 6192 cog line or something like that, 6132, we've only been there that one time. We didn't spend enough time there to evaluate that in depth. I don't have weeks of data to analyze to validate that cog line. But we've had 32s as a cog line since I've been dealing with it in the 2800 area all the way up to 6132. I'm pretty sure it's a cog line. I just don't go through the extra added step of validating it. And for that one, I can't because I don't have enough data anyways. I've only got 1 day of data when we were at 6132. It's odd in the sense that we don't have a rhyme or reason behind it, right? Why those numbers? I really wish I had an answer for that why. But what I was taught and what we found over the years when it comes to um, validating these levels is that we would go into a micro time frame using something like Bookmap, Jigsaw, tick charts, second based charts, and we would look at the trading volume and options volume when price got to those levels, and then how price and the options volume changed when we left those levels or attempted to leave, because we would get, like a band or a zone, we'd get 20 or 30 cents away and stall, not be able to break out. Just a second, guys. All right, sorry about that. My medication is delivered to the house and it's refrigerated. So I always get the call when it gets delivered that, hey, your medicine was delivered. Yay. So we don't know why it happens at those particular levels. We just know that it does. And after years and years of seeing price respond at those levels, I've given it so much time, effort, and attention that it has my respect. I don't know that every single time we get to that level, especially in after hours or pre market, that we're going to see the response that we should see. But I mention it anytime I see prices headed towards one of those levels I pointed out. You'll see that the open, high, low, and close levels on daily and weekly and monthly line up on those levels. Point of control on volume profiles will land on those levels. When we use measured move and quant lines, quadrant lines, and Fibonacci lines, they will line up on those levels. So use them, right? If you want to take the time and the effort to do the legwork and spend the weeks and weeks that it requires, get Bookmap, get the data that you need, and then put that thing on the smallest time frame that you can and go back in the past in slow motion and study the volume on the options and the stock when price is around those levels. That's what it'll take to be able to begin to understand why we call it a cog line and what we're looking for when price gets to those levels. If you don't want to go that deep into it, just draw those levels out on the chart. You're only talking three lines in a 100-point range: 11, 32, and 92. Draw them out and look at how price responded to those levels and how often it lines up there when you do look at things like a volume profile or open, high, low, close, or measured move. They come into play a lot. They're not support, they're not resistance. They're just an area where we expect a lot of trading activity. And if we get near them, we'll gravitate to them. So they become targets. So that's cog lines. The other topic today is also a request from the chat on, you know, really, when I first read this, I thought, "Oh, we've done this before." But when I went looking for it, I couldn't find a video on it. So what I think is we've done this before in live streams like this one, but we don't have any videos of it on the website, which is just a glaring error, really, and it needs to be addressed. So I'm hoping this will get added to the to the website, right? Either I end up making a separate video or one of the other moderators. The topic is about the different orders that we can use to take a trade. And I had copied most of the question in its original language so that I didn't, add anything to it. The question was, does the bullish bears have video and or training available specific to when you are buying or selling? And they're asking this in reference to market orders, limit orders, stops, trailing stops, going short, going long, reversals, OCOs. Now, when I was hired by the bullish bears to work on the library, it was for the next level. I didn't handle the intro stuff, and when I asked, I was told, "Oh, hey, don't worry about it. We'll handle all the beginner stuff. You just do all the next level stuff." So that's what I did. I didn't answer these kind of questions. So now when I look back, there's a lot of holes missing from things that just didn't get answered, like this one. So let's work it out. Right now, obviously, what you're trading will come in on when or why you would want to use these different ones. But let's start with the simple stuff like market orders. If we go into options for an example, and I just click the button here, oh, not that button. We just click that button, it's going to try to fill me at the natural price. It's what's showing on the ask. If I want to do it, it'll do it, right? That's not technically a market order, but it's so close that that's what it would be, right? And I can change from limit right here and just put in market order. But if I do, it won't even let me put a number in now. It's just going to fill me for this call at whatever market price. Good luck. Hope it works. You don't want a trade that way, right? You're very likely going to get filled at a price that isn't beneficial to you. So why would they offer this if it's not beneficial to you? Well, because sometimes getting the trade on or getting the heck out is more important. So you have to make a decision when you go to get in. How important is this trade? Is it more important that you get a fair and equitable price? Or is it more important that you just get the darn thing on? If it's the latter, then market order into it. You will get filled, guaranteed, but you may not like it. The same thing can be said with stock, futures. It really doesn't matter, right? So you have to weigh that decision on what do you want to do here. For me, if I'm day trading something like the SPY, I will market order into this. And I know we're not supposed to say that, right? Because that's not responsible and equitable and it's just not a good answer. But SPY has one of the most liquid markets and the bid ask is usually fairly tight. So if we're doing something crazy like the president tweets and the market's spiking all over and price gets really wide, I won't do it then. But if it's just a normal day doing normal stuff, look at the penny difference here. I'll market order in this and I won't even question it because I just give me the darn trade. It's a penny. Here, you can have it. Right? You try doing that in something like, oh, I don't know, Visa, Hog, McDonald's, you could lose 30, 40, $80 getting into the trade and another 30, 40, $80 getting out of the trade. You don't want that kind of slippage. So know your market. How wide is it? How important is what you're trying to do? This does tie directly into positioning. And if you're day trading or you're using futures, getting in at a specific level, support, resistance, rejection zone, whatever it is, sometimes your quote positioning is more important to you than the cost of the trade. The slippage is what we say. You again need to make that decision on your own. Which one are you trying to really focus on? So I think that really covers market orders. and or limit orders. Use limit to work the order, to be specific about what you're trying to pay and or what you're willing to take as payment, because it's the same way if you're trying to sell to open, buy to open, sell to close, buy to close. Limit gives you control of the price and holds back while you negotiate. Now, when it comes to stops, there's no wrong way to go with stops. You just have to keep in mind that the size of the stop is eventually limited by the movement in the underlying that you're dealing with, right? So take futures for a moment. This thing moves in quarter increments, 25 cents at a time. I can't use a stop of 15 cents, it just won't play. And then if I did use a one tick stop, a 0.251 tick stop, I'm going to get stopped out immediately. Immediately, right? It's one tick. I'm going to get immediately stopped out. You have to give the trade some room. How much room is on you? There's no book or criteria or rule that says your stop needs to be X big, or that you can't make it quote too big. I know a lot of books back in the day that talked about trading futures when there was no mini, when there was only the mini, no micro, and they would use stops that were below yesterday's low. You know what I mean? Like 40 points away, and that would be a part of their trade program. I don't know about you guys, but I don't want a 40-point stop, right? That just doesn't work for me. Now these trailing stops, I have had no success with automatic trailing stops. None. I think, in my own little opinion, that trailing stops were designed by two engineers sitting around talking about it. And they said, hey, do you think it would be pretty cool if it would follow us at X distance away from price? And the other one said, dude, that would be really cool. Can you do it? And they just did it just to see, can we do it? Yep. Is it a viable tool that anybody would find value in? Probably not. I haven't had any luck with it. So I don't use the automatic trailing stop. It's just me. Good luck with you if you do use it, right? It's whatever. It's not to say that I don't want to trail my stop, because I will, but I'll do it manually based on my own criteria as I see fit. Depending on what you trade, you may not want a stop. And this is something that can sometimes be a little hard to explain, but take options for an example. Options do not move solely on the price of the underlying market. So if I buy a call, this call price is going to move up and down, even if SPY's price doesn't move at all. Think about that for a minute. This option is moving for a lot of reasons, not just because SPY is moving. And the most that I can lose is however much I spent for that call. So if I get some way out of the money option for $10, that's my max loss, $10. Do I really need a stop on that thing? It's $10. I can't get coffee at Starbucks for $10 anymore. I don't need a stop. Even worse, if you sell to open something, say some out of the money $4 or $5 wide options trade. This is 80 cents in profit max, and it's risking $4.20. Right now, you might think, man, I don't want to lose $420. Let's put a stop on that. Yeah, but hold on, time out. This thing will move drastically for a lot of reasons other than price. And it very likely will stop you out even though your position is still safe. So this is a 590, 595 put credit spread or long bull put spread, whatever the name. Yeah, bull put spread. The goofy, silly names. It's a short vertical put spread. We'd call it that. If I hit confirm and send, it'll show me the break even. That is 594.20. As long as price closes above 594.20 at expiration, I'm not in a losing trade. But the P&L of the trade, while I'm in it, can fluctuate a dollar, $2, sometimes $3. But as long as we're not below 594, I'm good. I'm not in a losing trade. So again, I might not want to use a stop here because it could kick me out of a trade that technically isn't losing. It just has a negative P&L. You have to make that decision before you get into it. Do I want to use a stop here? Since I started trading in options first and I went to futures later, I used to really hate stops and I would not use them for most of the things that I traded. And I was vocal about that when I would tell people I hate stops. I'm not using them. Well, and then I started trading futures and you want stops in futures, right? That's just you just do. So I had to eat that all the times that I said I don't like stops and I don't want to use them because I started trading futures. There is a time and a place, and you have to make a decision about that stop. There's a lot of things about stops that are not very cool. They don't work on options in the pre-market, right? Because options don't trade in the pre-market except in the futures. They stops on stock won't trigger after hours. You have to use limit orders on stock to get in and out in pre-market and after hours. Price can just completely jump over a stop and the next day open way under what your stop was. They're not infallible, right? So stops do not solve the problem of risk. And so you really want to understand, when is this stop going to work? When is it not going to work? And when am I at risk of getting stopped out of a good position? Most traders that I know that are new to trading really get their butt handed to them at the open. They'll get into something, say today, 2 or 3 o'clock in the afternoon, and they put a decent stop on into the close. And tomorrow that stock opens gapped down, triggers their stop, and then continues to move to the upside and leaves them leaving out of the trade. They're done, kicked out. Well, yeah, I mean, that sucks. So you have to recognize the volatility threat, right? That volatility can just reach down and tag you near the at the open, near the close, near economic events like FOMC or 10 a.m., 10:30 oil report. Those kind of events cause just enough spike to kick you out of trades. So a tight stop fits that adage that says scared money don't make money. Is if you run a tight stop, you are inevitably going to get kicked out of a trade and then you'll get left behind. It sucks. But in futures, the alternative is even worse, right? That you don't have a stop, you can't react fast enough. The market can make a drastic move and you'll have a loss much bigger than what you wanted to deal with. Now, the discussion about shorting, we always try to put this in a category on shorting should be left for experienced traders. The reason for that is, to short stock, you have to borrow shares from somebody that has the shares and you have to pay for that. All right. So you pay a fee, finder's fee. You may even pay interest on that. Now you got the stock and now you short it. Well, we just talked about how stops don't work and squeezes can perform radical maneuvers. That whole situation in GameStop back with the whole Reddit crowd and that big explosive move. When you're short, there's no ceiling to how far a market can go. If you buy a stock, the lowest it can go is zero. You know what your max loss is, but when it goes up, you don't know what your max loss is because there's no ceiling and you borrowed it. So there's just all these added fees and costs. And then how much you pay to short something ties directly to how easy was it for you to get your hands on it. Stocks have a listing of easy to borrow, hard to borrow, and in that situation, you might pay up a lot to get your hands on a stock to be able to short it. I was looking for something that might be hard to borrow. Nothing's really coming to mind. I was just looking at a hard to borrow stock the other day, and for the life of me, I can't think of the name of it. But there's plenty out there, right? Where I'm looking to see hard to borrow is right here. Now, you may be on a different platform than me, so you might see that somewhere else. But if it was hard to borrow, we would see HTB, hard to borrow. Also, if you try to short it, something should pop up in the trade confirmation box that will tell you how much you're going to have to pay to short that, what the fee is, and the interest, and blah, blah, blah. When it comes to shorting, the recommendation is don't do it unless you are an experienced trader. And instead, if you want to go short, buy a put. Even traders who don't quite really understand options have less risk just buying a put than they do trying to short a stock through the shares. So whatever the cost of the put is, that's your max loss. If I buy, a $73 put, that's my max loss, $73. I don't want to lose, but at least I know exactly what my loss is, and I'm good right there. The P&L from the broker will tell me if my trade is winning or losing, right? And of course, if you buy it at 72, if it goes up, you're making money. You may not know how much you're making, but it's a safer way to go. If you don't want to trade options, look for things that are inverse. So if you want to trade short, find SPY inverse, find QQQ inverse, right? It'll make money if SPY falls, but you didn't have to sell to open that. You didn't have to borrow anything to short it. You would buy that product, and if SPY falls, you make money. So that's not the only one. There's a lot of short products out there, double and triple leveraged, maybe, but they are, quote, inverse ETFs, even if they're single stock ETFs. So take that route. It's still a chance for you to quote, buy stock or buy a product without it being options and without exposing you to things that are hard to trade. See, it says ETB right here, easy to borrow. I shouldn't have pointed out this. This means it trades 24 hours a day, so you can trade it even in the overnight, depending on whatever your risks are and your rules are. The borrow or not is right there. Each broker lists this stuff in different spots. Thinkorswim has these little tags on their symbols now to where it'll say 24 on it. right? Like all of these 24, 24, 24. It just tells you it could trade 24 hours a day. And they are uh, ex- extended hours tradable, EXTO eligible. Look how many of these products nowadays are quote 24-hour a day traded products. Now, I'm taking it from the question that this person asked that it really wasn't about options because what is listed here doesn't cover one thing that we would do in options, which is go sideways. This is asking about going long or going short, but in options, we can go long and make money. We can go short and make money. We can go sideways and make money, which I absolutely love that. So let's just kind of work through for a moment getting a trade. We're looking at MOS. Maybe I decide I like this. I'm going to buy it here and I want to run it long into 38 over the next couple of days. And I'm going to use 36 and a half for my stop. If that's what I was going to work on, trying to answer this question about, stops and all of that, I'd want to work the order. Right now, the stock's running at 36.84 and a half. Well, it's a half of a penny, right? How you going to trade a half a penny? That we wouldn't, right? We would just work the order. So it's a 1 penny wide bid ask, and I can see that it's trading in between those two. So I could put in the ask on 84, even though that's the bid. I could try to fill there and just keep working the order until I fill. And if it continues to rise above, well, then I just wait, right? If I have to, I can always bring my order up and get filled, or I can turn it into a market order and get filled. I could also do an OCO because that was a part of the questions. OCO, one cancels other. So with an OCO, I can get in. Let's say I get in here, right where we're at. I just market order in 36.84. Boom, I'm in. But I want more if we go lower because I think a better price would be 36.80. So now that I'm already in, I put an OCO that says if we go down to 36.80, fill me there. But if we don't go down to 36.80 and we instead go up to 37, give me some there and cancel the 36 order, 36 and a half, whatever it was. It's OCO. So one of those orders will cancel the other one. And we can use that for stops and exits. So I could get in here, have a target here and a stop here, and use OCO that says, okay, if I get here, close my trade with profit and take that one off the board. I don't want both of them. I don't want one left behind. That's an OCO. There's a lot of ways to run the OCO. It doesn't have to be just stops and profit targets. You can add more to the trade. You can mix it up, add more and or cut some out. It's however you decide. Most of the day traders that I know, especially in the futures, they're not messing with any of that. They're just getting in and then they're getting right back out again. But it's worth digging into because it does give you a lot to offer, especially if you're going to build out a position. And I've got a really good example of when we might want to build out a position. Let's see if we got a topping. Yeah, we do. So say I was trying to short this and I had this previous high back here. You know what? Let's do it on Thinkers on let's do it over here so we can turn off price. That'll make it easier. So say I was looking at this and I wanted to go short. My concern is I want to go short off of this line or anywhere in that area, but I would be worried, oh, well, what if it doesn't go up there? I'm feeling short. I want to get in it now. And I go ahead and I get in it now. And then what happens? If we go up higher, well, get me in where I originally wanted to get in. Give me more at that spot. But what if we just drop down some and then stall out? Well, then get me out down there and I'll try to get in at a better price later. So I'm going to try to work the order a little bit, right? That wasn't the button we wanted. So we can see here it started to fall back down. If I had gotten in where we were talking, it went up a little higher, but now it's down. Maybe I take some off and I'm still looking for that opportunity to get in at that higher price. Well, now I got that chance, right? And you can keep working that order that way to where sure you tried here, you took it off, you tried here, you took it off, you tried there, took it off. And I've even done it in a way where I added one and then it went up some. So I got in on another one. And when it dropped down, I got out of the first one, but I was still in the second one. There's no wrong way to work on it, right? It's just having the idea that if I put on a stop, it can be a stop profit, it can be a stop loss. I can put it where I want. It will get me in, it'll get me out. And that's what you want to focus on when you're trying to make a decision about using a limit order, using a market order, a stop, or a trailing stop. The price you see, try to negotiate with that. Don't market order in unless you really need that trade filled immediately for some reason, like we talked about earlier. Otherwise, that price is just a starting point in the negotiation. I don't really know what else to say about stops at this point and entries and getting in and getting out. I'm sure some of this question was about the win. Do do you let the candle close? Do you wait for the new one to open? Those kind of questions. And sure, it does tie into when am I going to get into the trade? The question is, the trouble with that question is that it doesn't matter, right? If it's a losing trade, if you're on the wrong side, it won't matter if you waited for the candle to open or if you got in before the last candle closed or what I mean, you're going to lose anyways. If you're on the wrong side, you're going to lose. So maybe that's a bit fatalistic, but that's just the name of the game, right? So I wouldn't get too hung up on the idea that got to wait for something specific. Now, me personally, I don't necessarily hold to the adage that the current candle needs to close and a new one opens before I get in. I'm not a big fan of that unless the candle that I'm waiting on needs to be a particular thing, like a doji, a hammer, marbozu. If that's what I'm waiting on, then I have to wait for the candle to close. So I think I've run through just about everything we could run through on that, unless there's questions on it that we can get into that is specific on that. I'd say let's start looking at some stocks. The drones, the uranium plays, and the quantum plays are still holding their own at this point. It's pretty ugly charts, though. Let's just bring them up, take a look. Now we still have to be worried about an economic event this week, and we've still got jobs data and all that. The G7 summit is coming. So that's between the 15th and the 17th. This week we got non-farm payrolls, uh, more job numbers this week. ISM, that was we're done with ISM. We got jobless claims, non-farm payrolls, CPI. So there's still other things, and the deadline on the 90 days on the tariffs are looming. So we got to get through that still. We've got the bill going through the Senate. That's going to be issues. And the US and China are both saying that the other side cheated on the tariff talks. And so we've got that to deal with. So longs are still looking at a lot of threats, but the reversal that we called is still holding, right? Since the April lows, if things have been going good. So in my quantum list, some of these are not pure quantum plays. Got some ETFs like Sky and a couple of odd ones, but QTUM still looking good all the way back up into that previous high. We had that big blowout bar. Wasn't really even a gap and run. It opened and then it ran and then it dumped. But even with that little twist of fate, we didn't go down much, held the 20, and then we went right back up and tested it again before we gave up. So we're back again. This level, less than 90, it's still a significant level. Lots of risk, lots of fighting. There's this old market phrase that I keep coming back to: if 80, then 100. If 80, then 100. And we made 80, but man, we gave it up, right? Came all the way down and tested the 400 week. That's a huge level to keep above. We bounced off of it and ran right back up again. If we had failed that 400 week, I'd be done with quantum if we did that, but we didn't. We're back. Now we're testing this level, and I'm not quite sure that it's going to be one and done here. If you look at the way that we left last time in a small pullback and then the bigger one where we really dumped, that's the concern now. We are here. We had a little bit of a pullback on that last week, and we're running back up again. For all we know, this is the one, and we're going to push through it and get into 90 and get above and keep it. On the other hand, if we reject the number 2 push like I just demonstrated over here, this next one could be much deeper. And we break the 20 and the 50 and it gets really ugly again. So we have to be cautious at this level. But we were talking about SMH this morning in the live stream, and it had a situation kind of like this where I was talking about it would be a great short off of that high just because it's an LRE, low risk entry. To be fair, this is a great short off of this high because it's an LRE, it's a low risk entry. But in the space, chips have already had a really good run. They're looking tired. And after we get through AVGO's earnings, we're very likely going to take a break in chips. This is not chips. This is quantum. Do we get through the level or not? So there's an options trade we can put on to where if we continue to go up a little bit higher, we'll make money. And if we go down, we'll make money. And that's one way to go. It would give us that previous breakouts level. Or we could do it the other way around. If we go down a little bit, we'll make money, and if we continue to go up, we'll make money. And that would give us a pullback into like the 10-day moving average or the 3-week moving average, something like that. But we can't have both, right? There's a trade that'll do both, to where if we go up, we make money. If we go down, we make money. The problem with that one is if we stay in the middle, we lose money. We just have to decide, what do we want to do with it? So this one, just QTUM at resistance at the high after a nice run up off the 20. It's poised for a breakout. It's not at the Bollinger high. It's got plenty of room, nice momentum. Let's look at its peers and then circle back to it. And I want to trade the one that has the best options out of all of these, anyways. But I like this long, it's set well. Let's just shop around a little bit. Yeah, that's broken. We don't want that one. Ion Q. Well, there's that same horseshoe shape or that cup and handle that we were just looking at, but it didn't make it, right? It took a significant beat down like it did last time. So that's a little foreboding. Now, we could be setting up for a TRB here. All these lines are extinct. We don't need those anymore. If we get a 10 cross on the daily, we could start to look for a run back up. We just bounced the 20 from a chance to go long, a 20 period bounce, and a midday recovery. I like those kind of stock trades. Right? Look at that. We're hopefully above the half on the day. Ooh, just barely 39.04. If we're going to close above 39.04 today, that's a nice 20 period moving average bounce on a daily time frame in a space that's already hot, right? It's the quantum space. We're still above the 4 period moving average. Now, on the weekly, this big bar, I'm a little concerned that we're under the halfway point on that. That's like the control bar. And I don't like that we're under the half, but we got the 20 period bounce and a nice rally up off of those lows. So let's bring it out here. We've got a gap to fill around 43. We tried it once, we weren't able to keep it. That big bar now is the bar of concern. We got to get through this. And if we can get through that, then we got this gap to close. We haven't even managed to get inside of that bar yet, once we've broken down out of it. So that's the trouble we've got to deal with. Shoot, I still have the replay on. Turn that off. There we go. Wasn't much there, but it was enough. So for Ion Q, we got the bounce off the 20. If you want to wait for a follow through, then let's zoom out here. That way, a little too deep. If you want to wait, let it close today. And tomorrow, let it run up and break today's high of day, get through the 10, and continue to push towards the high of this island. So this is like a bullish reversal. So it's an island reversal, but it hasn't followed you through yet. We would only call it an island reversal if we gap up again to somewhere up here and then we continue to go up, right? Then it'd be a gap down and a gap up, and we would have our island reversal. We don't have it yet, so we can't call it that yet. But if you're waiting for that quote confirmation, get back above the 10. If you want to get in early, get in now today while it's still red and we've bounced on the 20. If you've heard me talk options talk before, you will get better call prices on a red day, right? It should make sense. People don't want to buy calls on a red day. They want to buy puts. They're trying to sell their calls to buy puts. Good. They're selling calls, take one, right? You buy it from them. It won't mean that you won't lose, just that if you do lose, you likely won't lose as much. But if you're scrambling to buy calls when everybody else is scrambling to buy calls, you're going to get a much poorer option price. Then, if it loses, it will lose oftentimes a lot faster. So, this tactic doesn't avoid losses, just helps keep the loss value down. That would just be a 20 period bounce trying to get this island reversal. And this big bar is the biggest threat of the whole situation because we're down below the halfway point. So on the run back up, getting through that mid is going to be trouble. And then getting through the top of the island to get the gap closed would be the next trouble spot. RGTI is another one. And it kind of had that same cup as QTUM, but it's not back up to the previous highs. It's just back up to this lower high. Still, it does have that kind of cup pattern to it. It's holding above all the major moving averages, including the 10-week, which is kind of a big deal. We rejected off of the top of the Bollinger Band and tried a breakout, but didn't get it, failed and came back in. We're still above the 50-day, but we broke the 20-day. We didn't get that bounce. If you're looking for the quantum play to go long in these, you would want to see that they are all moving back up this afternoon, not just one, right? So QTUM, it didn't even go down today, right? Well, let's say that differently. Since it opened gapped up, it didn't turn red here. It just bounced on the 4 and now it ran back up and we're through the midpoint of the day. With IonQ, it opened, gapped down, bounced, and sure, it's up off the low, but it hasn't turned green yet. So we're not getting confluence in these names. QUBT, it's another one that I like to play. Another bounce on the 4, like QTUM, bounce on the 4. So I like that. QTM's had a nicer follow through than QUBT, but it is green and it is a nice run up from this 20 period moving average. We got to be concerned of the range though. See that 50? That's what we hit on the high side today. So that's our trouble spot we got to get through. Looking at the Bollinger Band high, we've got room before we hit $15. So we don't have to worry about hitting our head there yet. And on the weekly, we've got room. It's only to like 14, but we've got room. See this Bollinger Band, we have to push it wider. It won't just go wide on its own, right? So price is going to have to push against it and then fail and push against it and fail to force that thing to turn and go up. So the only way we're going to get this Bollinger Band to widen out is to stretch it out. And it just takes time, right? Pushing on it. Just like we did back here when it was in a squeeze. Price pushed and pushed and pushed and it widened it out. Of course, here it really pushed. LAES is another one. Didn't quite hit that 20, but that was a part of the reversal. And then it stalled out. It still has that gap to close. Island reversal. Well, island, we don't have the reversal yet. That thing almost closed the gap, boy. Almost. It didn't, but it almost did. Speaking of gap, some analysts do this differently. So I'll explain how I do it and then how others do it. It's not about right or wrong, by the way. It's just about how you do it. So a lot of analysts will say If price got into this candle's range, anywhere in that range at all, that the gap is closed. And that's a really useful tactic if you are staying on a daily chart or higher. And there's a lot of people who don't go below a day. So if that's the way you do it, it makes sense, right? That this would be considered a gap close because price ran up, got inside that bar, and that's it. The gap is closed. That's not how I do it, right? It doesn't mean that I'm right and that they're wrong. It's not about that. It's just you pick one way and you stay with it. Don't change your mind based on whatever you have today. For me, since we closed here and we opened here, and that is the gap is not closed until we get back to that spot. That's just the way I am because, well, that's where we were. And if we're going to close it, that's where we need to go back to. That's the way I do it. But I can acknowledge that I've seen a lot of gaps, quote, closed this way. So while I won't call it a gap close, we got to respect the fact that price might not have a reason to go up here now. If we can't get outside of that doji bar, we won't get that gap closed, right? Makes perfect sense to me. So the midpoint of this bar becomes particularly important. So does the midpoint of our own bar for today, which of course we're good. We're in the upper part of our bar, but we're fighting the halfway point on that doji bar. That's what we're hitting today, right now, while I'm talking. So we got to get above that, preferably close above that, and then try to get through the high and then get that gap closed. This is it's not a penny stock, but it's a low float. It's really cheap. It's violent. This thing moves, right? I mean, it moves. And when we go in and we look at these options, there's not a lot here. The prices are crazy expensive for the size of the stock. When you've got 25-cent wide bid ask spread on a $4 stock, that's crazy wide. Now, let's talk about this from a few points of view. One, I'm bullish in this space, not necessarily for today. We've had a decent run in a lot of these names, but in this space, I'm still hot. If I wanted to start shopping around and buying stock, maybe not today necessarily, but if I wanted to own stock here, we could use the options for this. Now, the June expiration, it's kind of close. This is really ugly pricing. I don't really like anything that we see here. So I closed that one back up. We could look at some of those weeklies, but I'm going to just, jump to the chase and just go to the next monthly expiration. It's 44 days out. If I sell this $4 put and I can get filled at $1, actually 102, but let's keep it simple. If I sell that $4 put for $1, and then later on I get assigned at $4, my share price is actually $3 a share because I already got $1, right? So if we close under 4 at expiration and I get assigned, then my average share price is $3. Yay. I could immediately turn around and start selling $3 calls on the other side of that, right? Now, worst case scenario, we keep falling and falling and falling. We get below 3, we get into 2, maybe we get into 1. Do you really think this is going to go back to being $1? Technically, it could, right? Price can do whatever it wants, but the space has been hot since everything got hot in this space back in the later part of November for a lot of the others, and in December for this one. I don't think it's going to go below 2 unless this particular stock does something wrong. The space is already hot enough. I think the space is going to stay hot. So these guys could screw up their earnings. The CEO could get arrested. They could do something stupid like buying Bitcoin, some of those other flywheel plays that we've been seeing. anything crazy can happen, right? But I don't think it's going to do what the pot stock space did, right? The whole pot stock thing just dried up and all of them dumped. I don't think we're going to get that in quantum. So getting locked in at $3 a share is not bad, right? Because then if we sell $3 calls and we get more credit, we can get our average share price down below two, which would be my goal. Because I don't think we're going to get below two. And I'd feel pretty comfortable about that. So what happens if I sell this $4 put and I don't get assigned? Well, and I get to do it again. And if I keep track of it, if I make a dollar this time, and then I do it again and I make a dollar that time, and then I do it again and I get assigned, well, I'm $3 off of a $4 stock. So my average share price is less than a dollar a share. What's the max risk here? It's $4 of stock at 100 shares. That's your max loss, and that's if the whole thing just blew up, which is technically possible, but unlikely. If you want to just go long, give yourself some time because these things are violent. You could use that July one that we were looking at, and it may honestly be your better bet since September is twice the time frame plus some, right? And small accounts need that short time frame. You don't want to wait 100 days, even half of that 100 days to get paid. You probably are going to want to keep it in the July one. But let's look at September anyways. I wanted to go out into September to look at the volume. Wow. The lack of volume is what I should have said. We got open interest here. It's decent, but the volume today, you're making book if you're trading these options. Let's just say that 10,000 contracts traded today, almost 11,000 if I round up. Lots of calls we can see, right? Almost all of those options today, 90%, let's just say 90% was call options. And that's 100% above the 5-day average. So we're usually generating around 5,000 calls a day. That's not perfect math, right? But it's close enough. Napkin math, we'll say it. So this would be a day where you don't want to buy calls because everybody's buying calls. Don't buy calls today, right? Either sell puts or maybe sell calls, but don't buy calls because that's what everybody's doing. And we can see I don't want to use the word a lot, but we can see some volume here at the $10 strike. If they are selling calls, it's probably there, right? Look at time and sales. They're buying calls there. How do I know we're buying them? Well, it's green. That's easy, right? But they filled at 10 cents and the ask was 10 cents. They didn't work the order. They paid up, paid the high price for it. Same thing here. They paid 85 cents and the bid ask was 80 to 85. They paid on the high end of that, right? So they are buying those options. I'm kind of surprised, but that's fuel for the fire. QBTS. Honestly, this one looks better than all the others that we've looked at so far, right? Let's look at the stats first. Just the easiest way to go. 105,000. Wow. The last one we were looking at was barely 10,000. So yeah, that looks a lot better. 74,000 calls, 31,000 puts. Most of those puts are way out of the money, 10 to 20 delta, and most of the calls were at the money. That makes me feel like they are selling puts and buying calls. the weird thing is the numbers are odd. Normally, with this number ratio, it would be you sell like 5 or 6 puts to get 2 or 3 calls just because of the price differential, and that's not what we're seeing here at all. We got twice as many calls than puts, and the calls are at the money and the puts are way out of the money. So a little weird. Let's see what they're doing. Well, we can see those at the money calls, the 40 to 60 delta calls. They're selling to open calls at the money. That's crazy aggressive. Now, was the next question would be, are they selling to close or are they selling to open? Those are 19 strike calls. And we can see that the volume today is less than the open interest, which doesn't give us the answer that we were looking for. If it said 20,000 volume and 3,000 open interest, we would know 100% that that was an opening trade. But with this number, we don't know for sure. In fact, here's a good example right here: 69, and the existing stack was 51. So we know for sure these are new trades today. Not all of them, right? But at least, what is that, 61? At least 1,800 of those are new because they didn't exist yesterday. But with the other number, 3,000 and 2,100, we don't know for sure. But we can extrapolate and we can, check the bid ask and all of that. It sure looks like they are selling calls, but they're selling a lot more than they're buying on the puts, and they're buying way out of the money puts as if it's a directional play, which is weird. We wouldn't expect them to buy puts that far out of the money like speculators. That's what you and I do, right? We speculate. They don't usually speculate. They usually hedge. We can narrow down where they're at though. Go into product depth here. Nerd out a little bit. We want to see puts, and instead of open interest, we want volume. All 10 series. Where's the most volume today? June 6th, which makes sense perfectly, right? Because it's the closest thing to expire. It's going to have the most volume. Um, at the 17 strike, that's where the most options traded today were. That's 17 strike puts traded today. So we go back to time and sales. Only the put. 17 strike. Oh, yeah. It just turned green, right? All that put buying. Now, way up here, 42 strike or 42 delta. See, that's July 18th. We need June 6th. This expiration right here, it's white, which says it's probably part of a spread. But it hit almost on the ask. Buying puts. Let's tighten it up and just look at June 6th. Now it turned red. It's kind of a mixed bag, huh? But it looks, put them in order. It looks like they bought a bunch of puts this morning, and then I don't know, very likely they came in and changed their mind. Look at the time frame. At 8:52 they were buying puts like crazy. And then at 8:55 they came right back in and started selling them out. It could be two different players. That's absolutely possible. Price really hadn't moved that much from 1720 to 1734. and then 17 and a half. My time frames, by the way, that you see this 8:55, I don't live in market time, so add an hour to these times, and then they'll make sense. That was 9:55, not 8:55. So altogether, this is muddy water and not really clear. They changed directions, or we had multiple traders coming in with multiple biases. That's really not helpful. At least not in that one expiration, right? What would be better is looking at that tomorrow and seeing how many of these that were traded today are still here tomorrow. That would really help us out. Another thing I want to do is send this out and let's look at that option by itself on the chart. We're going to make it a line. No, we'll use Heikin-Ashi. So here's Wednesday's price action for that call, right? We should have been doing the put. There's the put. Wow, no volume today at all. So we can see that selling, and then they started buying it back. Just really indistinct, right? Not That's not the kind of options volume or options trading that you want to see. You want good, clean, decisive options data, not muddy water. They started to sell and they started to buy, and that's not good. ARQQ is another one. I mean, it's okay. It had its earnings and it didn't collapse. Tested that 20 like a lot of the others that we were looking at, and it did it earlier than the others. Now it's well, I guess not. It wasn't early. It's about the same as all the others, and it's just stalled out. One of the differences is that we really didn't get a gap down. It just went down, and now it's trying to run back up, stuck under 24. Nothing on this one really excites. QMCO, this one's just broken, and then ALUM blowout move, right? Big break. This is event driven, and when the event starts to fade, this is going to come crashing back down to earth. Now you can see all the moving averages have fanned out really nice, but this, make no mistake, this is crazy dangerous and not what you would want to participate in. So if you are interested in this one, wait for it to at least at the bare minimum, let it pull back to that white line, the 4-day moving average. What would be better is a 10-day moving average, right? Get a nice pullback to the 10 or the 20 like that. So out of all of the quantum names, I think Ion Q is one of the good ones, and then QUBT. No, not that one. Where was it? QBTS. Yeah, that looks really good. As a space, I still like all of them, and with them being so cheap, you can negotiate some of those short puts for a play. Maybe even that one that the Jade Lizard, right? That they talk about over at Tasty Trades might be a nice play on this because it's really cheap. It's violent. Uh, from a seller's standpoint, the Ivy rank It's a bit low. Probably wouldn't get much on the options sale, but at these prices, you're not going to get wild premium anyways, right? These aren't premium traders markets. The other one that's really big right now are drones. And I got a hold of some info today on the United Arab Emirates and Joby, Joby. For some reason, I thought Joby had exclusive rights to the UAE. That was a misquote. It was that they had exclusive rights in one particular city in the UAE, and another group had another city. And it's quote, even that exclusive word doesn't apply there. So it was just somebody took license with some words in a article that I had read a while back. So that has to be fixed in my drone list that I had published previously. Gonna have to make some changes there. Still, JOBY and Archer, both of those two are in the United Arab Emirates, and Archer just completed uh, its Midnight, which is one of its products, Midnight test flight, and it went really good. And we went down, right? This is one of those sell the news. We didn't really get much of a buy the rumor, but we got the sell the news part, and we hit the 50. Now in this space, it's been weak. And that's because this drone talk, it's a long ways off. There's a lot of regulations, there's a lot of trouble. But same thing with quantum, it's a long ways off. And with uranium, it's a long ways off. The SMRs, they're not going to be popping those uranium facilities out in the next 2 or 3 years, right? It's going to take a long time. So in all three of these spaces, it's down the road stuff. That makes it a little rough to deal with, right? Because you get these shenanigans and all of these, there's the big players, Amazon, Google, Microsoft, Meta. They're in every one of these products. So they're not pure plays, right? Archer, that's a pure play, but it's a $13 stock, keeps getting rejected, holding the 50. You know what I mean? It's what we got to deal with. So I do like Archer and JOBY, but these markets are rough. I've been in most of these for a while, not because I timed it well or anything like that. It was just back in November after their earnings. Somebody was asking me about them, and they were, less than $5, and I'm like, wow, this space is really lighting up. And so I got into most of these names, not the crazy expensive ones and the ones that are hyperscalers like the Google, the Amazons, not those, but in these pure play ones, I've been in most of these since November, December, and I've held through all of this violence. I'm even gotten a little deeper into some of them, buying on the way up sort of thing. But my positions are not really big because they're crazy violent, right? So now a lot of people are asking, well, when do I get in? What's the trigger? And what am I going to do for a stop? This is so violent, and my entry is so low. I don't need a stop. You know what I mean? It would. I don't want to say it's impossible, but it would be very hard to hit my entry price right now. We're nowhere near an earnings event. And so, unless there's some criminal headline, I'm not going to get hit. But if you was trying to get in now, you'd have to try to figure out, what am I going to do for a stop, and where's the getting out point? We're looking at least 2026 in these things, right? Because that's where a lot of the regulations are supposed to start. And then, like the JLBY thing, it's supposed to be a 5-year plan. Archer, same thing, 5-year plan. These aren't going to be panning out in the next 5 weeks. It's going to be 5 years or more. And a lot of these names very likely won't be here in 5 years. They'll get absorbed or knocked down into a penny stock and go into pink slips. So you have to make a determination on, is this a trade or a buy and hold? I don't want to say investment because that's really not our theme here, but a buy and hold says you're willing to hold on through some pretty negative stuff for a long term kind of payout. My argument on that is you shouldn't bag hold, right? I'm a huge believer in this. You should not bag hold. So if you did buy in on the 50 bounce here and it didn't hold, you should have a get out point because you can get back in at a lower price if that's what you want to try. I would say if it doesn't hold the 50 bounce, I probably don't want it, right? So say you get in today, you use 50 as your line in the sand, or use today's low as your line in the sand. And if it breaks that level, you find your exit, which means you don't have to put a hard stop there. You could just set an alert and say if price after I get in closes below that line, the next day I will start to exit my position. And you can get out in chunks. Say you buy 100 shares. You could exit 50% of your position if we close below that green line and have another exit at another price point lower, say $9, nice round number. And you could use that as your next exit point and just abandon your position, right? The third point for me, the max entry exit, would be this gap close down there. If we got there, I would close it. If we closed below that, I would close it and say, that's it. I'm done with this position and I'll have to find a new entry somewhere. Maybe a bounce on that 400 daily, although I wouldn't like that. That shouldn't be the 400 daily, anyways. That should be like a 100. No, why it's blue. Yeah, that's a 100. So 100 shouldn't be below a 100 daily, anyways. So use that right as a guideline. Now I know bag holders that say, "Well, I'm in it to win in long term, 20 years, blah blah blah." I just don't like that. It's not my style. I don't want to do it. But if you're comfortable doing that and you're okay with the idea that this company could, go to zero or get bought out, or you could end up bag holding from $10 down to 30-cent stock, if that's okay with you, then do that. I don't like it. No, I mentioned it last week. And I've been working on it, but it's a big list. The question is about robotics, right? So I'm working on it. It's just a lot of work. And right now I'm just listing out the companies. I- I've barely even started to get into their contracts or what particular market they are offering. So the best I could give you is just the list itself. But I don't want to share the document yet because the document isn't complete. So from that, if you do want just the robotics list, here is the stocks. I'll put it in the chat too for anybody that wants it. But my argument is I still have a lot of work to do before I present the robotics. And if you look at some of the big names on there, it's the same ones from the drone list, the quantum list, the SMRs and uraniums list. Like Amazon is on every one of those, right? For an example, NVIDIA is in half of those. And I mean, even Tesla's in robotics, right? So it's a big space. And I will continue to caution people on these themes. Pot stocks was lit up a few years ago. It had a lot of hype, a lot of background. Everybody was piling into it, lots of research. Look at pot stocks now. They're in the toilet, right? And all of those plays turn to ashes. So, at any time, these thematic plays, they can go cold again. And maybe they go cold for a couple of months. Maybe they go cold for a couple of years, like pot stocks. We all know someday pot stocks are going to come back. They're going to have the legalization fight again, and it gets all the hype. But it's not coming anytime soon, right? So with these drones and SMRs and robots and all these, just that's why I don't want to be a bag holder and just have some blind position that I'm willing to hold forever and ever. Amen. I want clear rules on where am I going to get out. Our cat was doing pretty good. See the nice little push up here. And Jeremy shared, it's not in drones, but he shared some information on OKLO yesterday that these guys were offering dilution. It turns out they weren't the only one. If you got to poking around, there was some other ones. Um, oh, where is it? I put it in the chat earlier today too. Oh, darn it. Anyways, it's not this space, but there were two other really big name stocks that had dilution. Um, they filed a mixed shelf, so got to be careful with that. You can see the punishment this thing is taking right now, and where is it going to end up? I mean, I don't even know. But there's your cup. We're expecting, to see some sort of handle here, and then we'll see. It's not looking good at this point. Now, on the drone list that I put together, I tried to be specific about what kind of drones are they doing. That may seem funny if you haven't dug into the space yet, but you've got your military drones that are used, carrying missiles, monitoring war space. That's completely different than commercial drones that are carrying packages or monitoring the weather. Farmers use them to look at their crops, survey property and land. There's commercial drones that do light shows like fireworks and stuff like that. So when you go into the drone space, it's not just some, commercial flight little handheld remote control toy, or it's not just some military payload. It is a wide space, lots of applications. Where I started to dig into things was what spaces do these drone companies need? Like satellites, communications equipment, cameras, the devices for communications through different what was the word I'm looking for? The software communications. So that if you look at the names on the list, I try to dig into which ones of these companies are supporting drones, not necessarily developing their own drones. Maybe they do software or one of the other topics that I had listed. I tried to keep my list only in the US, but there are like China ADRs that are in the drone space. I think Israel's got two ADRs in the drone space. So if you wanted to be more specific and cut out some of those big dogs like Lockheed Martin, Nvidia, Google, Amazon, your list would look a lot better, right? Get the pure play instead of those monster. Even Stellantis, I look at that and like, what are you even doing here? You don't belong here. But whatever. Honeywell is another one that stands out where it's like, wait, why is Honeywell in there? Wait a minute. Maybe Honeywell ain't in this one. It's in the quantum list. Yeah, yeah. And it's weird to think of Honeywell in quantum, but there you go, right? I still think chips are done. We could get a little bit more of a lift into the next earnings tomorrow with AVGO, and then that's it. So we're topping out everywhere. We could break and run to the next level, or we could come flopping right back down again. If we wanted to play a what if, XSP would be a nice way to play it since this is like the S&P except you can't get assigned the stock, right? It's like the SPX as a cash secured product. It's like this, but the SPX is more liquid, but it's also more expensive, right? This is $5,980. SPY is $596. Well, 597. XSP 598, right? So much cheaper than the SPX, and it's cash secured, so you can do crazy kind of positions like trying to sell options in the money. It will have a European assignment, so no early expiration. And when it does expire, if you are in the money, it's all dealt with through cash settlement, no stocks. So it offers more than the typical trade offers because of that. But it's not as liquid as the SPY or the SPX. So getting filled can be a little tricky. We got June 20 expiration. Let's check on something first. We know we got this event coming up on the 16th. The G7 summit from the 15th through the 17th. This is on the 20th. So that will happen before the expiration. And we've got FOMC before then, too. So FOMC is on the 18th of June. We got to worry about that as well. So, with all of those things in mind, it's possible that we could run into FOMC. We've certainly done it before. We're going to turn some stuff on here. We want the line for the monthly expiration. Show expiration Friday. That's the one we want. So to get there, go to time axis, show expiration Friday. So now I'm going to get that red line that shows the expiration. And I already added an indicator that I built that shows the FOMC. So I'm going to remove all the stuff except events. And turn on FOMC. And what we're looking for here is a ramp up into FOMC or down, and then an options expiration behind that. Because in the current situation, we could get a run into FOMC or a drop. Sadly enough, a lot of those look like they just went sideways into the event, not really offering a lot of insight at all. I think it's a fair shot to run both, but I would be more inclined to go to the downside. There's an argument behind that to be made, right? When you ask what's more likely, can we go up from here? Yes, absolutely. But we've already run from 575 back up into this high. And we have to ask, like, why would we go higher from here? We would need, like, what, good news or something? Something on the Senate bill? Something with the China tariff agreement? Heck, even the tariff agreement itself, we're at like day 60 and a 90-day reprieve. So that could be one of the things, something to juice us up even higher from here. Otherwise, downside looks good. 575 is a good starting point, but let's see how far we could go by June 20. It says $16.80. Since we're trying to reach, we don't want to round up in this situation. We want to round down. Instead of saying that we could go 17, let's round down and say either 16 and a half or 16. And that's because you don't want to presume higher than you can go. Right. If I was doing risk, then I would say let's use 17. But if we're talking about buying calls rather than selling calls, 16 rather than 17. Hopefully that makes sense. So from 596 and a $16 put lower than this, that would be 580. It's a nice round number. $2.61. I mean, I don't want to lose money, but at least it's not thousands of dollars, right? And if you don't like this number, you can add another one to the short side. I'm gonna do what I just did, so I didn't have to add more contracts here, but I'll change it now just to make it what we wanted. 580, 579. It's a $1 wide debit spread of 15 cents. Sorry, I was talking dinner plans with the wife. So SPY 580. right? Max loss 15 cents. The profit potential on that trade, if we were to max out, would be $85. Now you're not going to max out. That's just the rules, right? You're not going to do it. But you could get like half of that. So if we could get 80 and we cut that in half, we could make 40. So you want to risk $15 to make $40. You're going to make more than 100% return on that if you get even a decent return, right? A decent move in the right direction. So that's not a bad play. Here's the hiccup or the problem with that. It is an out of the money play, right? And in these situations, if it doesn't work, there's very likely no recourse. With a lot of trades, we can roll it, adjust it, manipulate the spread, add more to the trade, kind of get something out of it, protect it. Something like this, so far out of the money, put it on and it doesn't work, there's no coming back, right? It's not gonna work, and you'll lose all of that, $16. And again, I don't want to lose, but all things considered, it's not that bad. So we have this. I'll throw it over into the analyzer just so we can keep it because I'm not done yet. We can do better than this, right? Surely we can do better than just a debit spread. So what else you got? How about we finance that debit spread? Maybe sell something like a 605, 610 call credit spread for $1.50. We are risking 350 for $1.50, and we can use that $1.50 to buy a put spread, maybe something closer in, right? So let's just chop this over into the analyzer so that we have that. And let's shop around for a put debit spread that matches this $1.50 in some way. So 5.95, 5.92, it's $1.12. It's not bad. So I got 5.96, 5.91. It's $5 wide. It's $1.86. We're a little high on that price. 5.90, 5.95. It's $1.77. If we took the $1.50 on the calls that we sold and we spent it on this, our risk here is the 25 cents in debit on the puts and or the 350 on the calls. So if SPY continued to go up, you would lose both of those. The calls would be at risk, they would need to be fixed, and the put spread would be at risk and it would need to be fixed. Now, since the put spread is closer to the money here, we could potentially fix it if it starts to go wrong. So we have that as a possibility. And of course, you could still go out of the money, right? You don't have to bring it in like I did. You could still go with that $16 target way out here, use the 580 area, and you could just get like 10 of them since they're $15 a piece and you're getting $150 in call credit. Could go that route. Having more than one is nice because then you can fade the play as it goes. I'm curious on what a butterfly would get all the way out here. So I'm just going to price it. $1 debit. Let's throw it into the analyze and play with that one a little bit. This is where we might be able to set up like a broken wing butterfly or a skewed fly, ratio fly. All right, the tent of this thing, the body, sell the body, buy the wings. We sold the 580. That's what we would need price to hit is that 580 to get max profit. Max profit would be uh, basically $1 because these are $1 widespread and it's showing like a debit of one. You could fill that thing for a penny at this point. The cool thing about that is you could actually stagger it all over the place. You could do an 82 in which case you would buy another 81, sell the 82 twice, and then buy the 83. And you could just stagger these butterflies all the way up, each one getting a little more expensive as you get closer to expiration, but or closer to the money. Just like that, right? In this one, you're buying the 182, excuse me, you're buying the 181 twice. So there's your overlap, but you've sold the 580, the 582. You would do it again at 584. So you'd have two 583s. You see what I'm doing here? And each one of these is a penny if you work the order. So you could really layer out that downside to where if we hit in any of these, you're going to pay out really nice. And yet, if we don't, what do you're out a dollar and commissions, unless you're trading on like Robinhood or Webull or something. So if we do the same thing again one more time, see if we can get to 84 and get that one for a dollar, which I don't think we can, but try it. Sure enough, 84 is trading for a dollar too. At some point, we're going to find one that's more expensive than a dollar. There it is. Now we're starting to move. And I would bet, even with that one, that if we worked the order, we'd probably have a chance to get it for a dollar, anyways. So, of course, the worst could happen. It could land on one of those odd numbers instead of the even numbers that we picked. But otherwise, you can really layer out the downside. And what do we have here? Two, three. We got $5 at risk and commissions. And that's nothing. So that's a lot. What if we just take one and make it bigger? We'll make it $5 wide. And imagine that it's still only a dollar. I think maybe it's locked or something. We'll unlock it. Yeah, that's what I thought. All right. $25. That's funny. Okay, there's a realistic butterfly, $5 wide, 580, which is the expected move. Max payout if we pay $25 for this thing would be $475. We could expect, say half of that. So at least $230. Now we can play around with the angle. This loss here is $25. Can we get rid of that? It's a trick question, by the way. Yeah, we take this and we put it on the other side. What's the chances that SPY breaks 575 between now and the June 20 expiration? I mean, technically it's possible, right? It's just not very likely. We would need a real good reason to sell off from 596 to 576, let alone get below that, right? It's a 20-point move. We're only projected to make 16. So let's take this risk and put it over here. We do that by shifting the strikes. I want to turn this into a custom trade so we can move every one of those strikes. Let's try to move the 585 up one. Never quite sure which way to begin the move. So this showed me I picked the wrong one. See how now down here there's no loss, but this side has loss? I moved the wrong one. We want to do that the other way around. So we'll put the 585 back and we'll move the 575 down one more into 574. All right, we've reduced things here. Let's unlock this, but not enough, right? It went from $25 loss to a $14 loss, but not enough. So we got to move it again. Let's try 73. All right, now we're at $3 credit. Nope, still $3 loss. We need a little bit more. Now we're in the green, $7 or $6. But at this point, if we don't sell off in SPY, we would get $6 or $7 to pay the commissions on this butterfly, and we just don't make any money, right? We don't lose any money, we just don't make any money. And with the position on, as it grows and matures, we could adjust the strikes, the expiration date, spread them out, add more to the trade. We can work it, right? Because it has life left in it. But we wouldn't take loss unless SPY fell all the way down and broke 575 and fell even lower than that. That's when we would get into loss. And max loss would be $293 ish, 293, 294. And I would argue, why would you take max loss? Right? Like if say really bad news comes out, Russia jumps into Ukraine and we get mixed into it, like really bad news stuff. S&P sells off, everybody's freaking out, you would just close this trade. Sure, you're going to take some loss, but there would be no reason for you to sit in it and watch SPY fall all the way to 575 and lower and then end up having to eat that. So we wouldn't, right? Just we'd have a reason to get out, we would get out and take a hand slap and we'd move on to another trade. So if you're looking at this and you're thinking, I like that bend, that's pretty good. I like that. Well, this is one way to do it. And all we did is we broke the wing, right? We shifted one side lower. But there's another way that we can do this too. And I'm just gonna get rid of a lot of these other ones. So we don't really need them. They were just $1 wide butterflies. So we're gonna take this, turn it into a custom again. And instead of going $5 wide or $1 wide, $5 wide like we did, let's set this to 75. This to 85. That was loud in my ears. And that's 80. So $5 wide, just like the other one. Only now we want to consider how do we get rid of this risk and make the other side bigger. We could add a put credit spread way down here. So if we look at those strikes that we have on this butterfly, we're short the 580, we're long the 575. So let's do one more of those. This isn't a ratio, or this isn't a broken wing fly. It's called a ratio fly, but it looks very similar to the other one, right? This is ratioed, and this is broken wing. You see, they look a lot alike, right? Now, subtle differences is the slope here and the slope here. That kind of gives it away sometimes. So in the broken wing, we just broke one side and they're no longer equal distant. In the ratio, It's still equidistant. It's $5 wide on each side, so it's equally distant to each. But the ratio has changed from a 1-2-1 to a 1-3-2. That's why they call it a ratio butterflies, because we just changed the ratio. Notice the slope is not the same. On the other one, the slope was the same. What we had on the left side matched the one on the right, at least until it kicked off. This one, the slope is different. It's a subtle tell, but it's how you can sometimes catch it at a glance and know that it's one versus the other. So, one thing that makes these different is you got more options traded, so your commissions are more. But the benefit is that you have more contracts, and so sometimes you have more choices. For an example, we have a credit spread built in here. If we don't fall the way that we're looking, that's fine. We don't really lose any money, right? SPY, if it sits where it is, it won't make us lose. It just wouldn't make us any profit. We could add a call credit spread on the other side, and that would give us some kind of iron condor type play. This is what we talk about when we say we're going to defend options. That doesn't always mean fixing what we have. Sometimes it just means adding more to what we have. And that would be just adding a call credit spread on the other side. A little bit of a tip when it comes to trading the indexes like SPY. Um, SPY's price for it being a very tight market with a really good bid ask spread, it doesn't always have a very fair value. And by fair value, I mean if I build a credit spread at the money or a vertical at the money, it should be half the width of the spread. SPY is never half the width of the spread. It's never fair. But sometimes the Qs have a better price in their options. So if you're long SPY, you could just as easily be long the Qs, right? Or short SPY, short the Qs, because it's the same thing. You're not going to have a 2% Q upside and a 2% SPY downside. You're just not going to have that. So if you want to go short SPY and you don't like the options prices, consider going short the Qs instead, or Apple or Microsoft, right? Because very likely, if we're short SPY, we're short Apple and Microsoft and the others. Sometimes you'll just find a better price that way, or use the ETFs if you want to, go that route. All things considered, that broken wing or ratio to play, whichever one of those, it's not bad. It's a bit of a lottery on the idea that we don't have any reason for it to fall at this point. We don't have momentum or trend or anything that says we're going down. We're just stalled out at this level and, really looking for a move. So it's a bit of a lottery, but there's no loss unless we overshoot the target and go even lower than 575 or 577, depending on which one of these you build. If we don't fall at all, the trade pays its own commissions off. That's not bad. Now, it's worth mentioning that this yellow line is your profit in the trade, and this gray line is what it would look like at expiration. So every day that you're in the trade, the yellow line is going to start to form the shape of this white line. So if we get to 580 by Friday, this thing's not going to pay you any money. I mean, very little, if any, right? I'm going to move the date forward to Friday. We didn't even really get anything, right? Let's try going until Monday, right? It's Monday, isn't it? Tuesday. Still not very much. Keep your eye on that yellow line. I'm going to keep moving forward in time. We're going to like back to the future, right? There's the 15th. And remember, this trade expires on the 20th. There's the 16th, 17th, 18th. We're getting there. The 19th. So the day before expiration, the the middle of this trade is just finally starting to see some profit. And then on the day of expiration, of course it goes, you know, it goes there. But you don't want to have to hold this thing all the way to expiration, right? Another feature of all of this would be the implied volatility. So as SPY falls, the IV will start to fall. And as you can see, I'm getting extreme with this, but as you can see, as IV falls, the yellow line is moving in your favor. So you would want to see the VIX spike, the options IV spike. You would want those things because that would really help this trade to make money. And that's a trade that benefits from the fall of IV. And a lot of time that's not true, right? If we did calls and if you buy a call and IV spikes, yay, right? That's great. But generally speaking, when you buy a call and price goes up, IV doesn't go up. IV goes down, and that hurts your trade. So in this one, price falls, IV rises, and the rising IV helps your trade. It's a win-win. But my point is, you need time to pass for this trade to work. You would never want to use this trade if you thought we were going to fall a long ways tomorrow. Use something else. So we checked out a number of trades today. There's really no wrong way to go in these. It was kind of just shopping around for some downside. It's always a bit tricky to try to explain how an options price is going to move and what our risk is for trading an out of the money option versus an at the money or in the money option. And I get it. We all want the cheaper one. So we gravitate to those out of the money options, but a lot of times those out of the money options have less of a chance of being even remotely profitable. So, you know, even getting 15, 20, 25% profit is really difficult when it's an out of the money option. And the farther out you go, the more difficult it is. But if you're near the money, at the money, or even in the money, you can get to 15 to 20% profit pretty easy, all things considered. So if you're losing more often than you win in the options trades that you take, reevaluate what strike you're picking and how far out you are. Try to get closer to a 50 delta, like in the 40s at least. And if that's still not doing it, then try to use in the money. See if that works. Kind of wishing I had got that trade on now. This was a gap and fail. If we look at how we ended on the day, we opened, gapped up, we ran even higher, and then we rolled over, dumped back down, and we're closing lower than the previous day's close. Now it's just a start. So if you're looking at it and you're thinking, oh man, I missed it, you didn't miss anything yet. What we want to see tomorrow is that we get below this midpoint that I just marked out, this 594 and a half. And for me, anyways, what I'd like to see is a gap up tomorrow, not a gap down. Now, don't get me wrong. If we do gap down, I'll take it. You can see this one over here. We gapped down, ran back up, and tried to close the gap, and then we fell anyways, right? We kept falling. It was a big day. It was beautiful. I'll take it if that's what we get. Same thing here. Um, this blue bar is solid, which means we closed here. We gapped down the next day, actually way down here, and then we fell and we ran and we closed a little higher. So, if we gap down, it's fine, but I'd rather gap up and reject that 597 so that I get a chance to go short off of the high rather than trying to get in from the lows when everybody else is trying to get in, right? I want to buy puts and I don't want to buy puts on a red day. That's my point. So let's see how it goes tomorrow. Hopefully this offered a little bit of insight. And for the person that was asking about, the stops and the getting in part, if what I didn't cover today got you where you needed to go, send me a DM and we'll talk and try to get some more clarity on that. That's what I got for you guys. Be careful, be safe. And if you don't have any questions, let's wrap it up and get out of here.